And as promised today, we're going to focus on the key topic of what's happening with the US dollar in the current environment. And hopefully by now you understand where we are coming from. We have some unexpected movements in the US dollar since Trump announced tariffs on April 2nd. Some unexpected movements in US Treasuries since then, and some very unexpected stock movements around the world in the last month or so. The volatility just amazing. And here you can see that the dollar index, which represent the value of the dollar against the major currencies, has been going through cycles over the last 30 years or 40 years. There's some ups and downs, but hopefully today we're going to talk about not just the cycle, but a secular shift, a regime change in the global currency system, and how that affect the US dollar and your investments. And with that, let me introduce our guest speaker today. Teck Kin, you there?
Yes, good evening.
Welcome. Thank you for your time. Suan Teck Kin is our economist and head of global research at UOB Bank, responsible for macroeconomic and FX research with a focus on China, Hong Kong, and the rest of Asia. He brought to us decades of experience in macroeconomic and equity research. And prior to UOB, he had various positions in equity and credit analysis. And without further ado, let me turn to Teck Kin. Hi.
Hi, good evening,
Yes.
Chi. Good to be here.
Thank you. So are we on the right track? Do you get a lot of questions from your clients about the US dollar in recent weeks?
No, definitely lots and lots of questions. Today, I just did a session this morning with the International Association of Credit Portfolio Manager. And that the question on the US dollar really dominated the discussion this morning. Although the focus was more on credit portfolio, how should we manage our risks and things like that. All these are the members from different banks. Definitely, US dollar is on top of a lot of people's minds in recent months. Chi?
Yes, certainly. Thank you. So it's good that you're talking to these big institutions about this topic, and today hopefully we can pick your brains on related things. So yeah, please take it away. What do you think? What are we looking at here?
Right. So let's start from the beginning, right? Why did the dollar even come into question, or dollar assets, US dollar assets? Why did it come to question? So it all started with Trump, with the April 2nd Liberation Day tariffs. It all started with that, and the number was too scary at that time, right? Those numbers were really more than what people had expected. As a result, we downgraded a lot of economies' GDP growth for this year, like what you are seeing on the screen right here, where we downgraded, for example, those small numbers may be Singapore, 1.7% for this year. Now, last year, Singapore grew about 4.4%. So this year, we downgraded all the way to 1.7% because of the tariff impact is likely to be significant at the start of April, when the Liberation Day tariffs were announced. On the right-hand side, you see Vietnam. Vietnam last year grew about 7%. So this year, we had expected 7% before Trump announcement. After that, we cut it to 6%. Right? So that is the kind of impact that we are talking about, a very severe impact. Now, of course, you have the 90-day reprieve, 90-day pause. So things kind of get back to a bit of a more normal, where you saw maybe some in China, factories are now running at full speed, maybe in some places. Or orders are coming in very fast and furious to take advantage of the next 90 days in July, maybe in August as well, right? So that's all, and that's how things are started. In the next page, you will see that we also downgraded US from 1.8% this year to 1%. Right before tariff, 1.8, now it's 1%, and the probability of recession, 40%. We are not changing anything right now, although we have a 90-day pause. But that's what things are at this point. There's still a lot of uncertainty, and investors, of course, are questioning, right? The investors are questioning the way that Trump is handling the tariff situation. A lot of changes. They put it up, Trump put it up there, and then after that, pull back, right? Put it up there and then pull back. And so today there is a new acronym for Trump. I don't know whether you saw that. Anybody saw the new acronym for Trump?
What is it?
TACO.
Okay.
Trump always chickens out.
Interesting. That's TACO. Yes.
Yeah, TACO, right? So all this uncertainty causing problems for investors, right? Later we'll get into that, Chi.
Sure. So the US dollar volatility or weakness, you think it's because of we have more downside risk in the US economy? People more worry about the US than other economies? It look like every economy is hit by this tariffs.
Right. So if every economy is hit by this tariff, because we export to the US and our exports or Asia exports to the US will be affected. But at the same time, on the US side, the US will be suffering as well under these kind of high tariff rates. Whether you're talking about consumers, whether you're talking about companies operating in the US. Even if you're manufacturers, your inputs will be more expensive than before. Even with the pause, the cost will be higher than before tariff, before Trump. Right? So these companies will be suffering in the US because of high input costs. So that is and you filter down to the US dollar assets as well, right? Equities market reacted very negatively, right? Chi, you are more qualified to comment on this.
No, I'm not. Yeah, sure. Yeah. So how does the Fed fit into this?
So the Fed, so what we are looking for is for the Fed to cut interest rates down the line, for sure, because the situation will become more difficult. Even with the pause right now, tariff rates are higher than before Trump, right? Compared to last year, for example. So in the US, companies will be suffering, consumers will be suffering, even at 10% or 30% or whatever, will be suffering, and activities will slow down, for sure. Activity will slow down, especially in the second half of the year, and the Fed may have no choice but to cut interest rate by before the end of the year. So we are looking at 3 times, 25 basis point each time, 3 times Fed rate cuts. And the next page, financial markets, is looking at 2 times at least, right? On the next page, you'll see the futures market is looking for 2 times interest rate cuts, meaning interest rate will be lower by end of the year compared to beginning of the year. Chi?
Got it. Okay. You don't. Can you see the screen? Huh? They cannot see it. People cannot see the screen? Yeah. Okay, sorry. We have let me pause here. That there's an issue with people not seeing the screen. But I thought Jim just showed me the screen before.
Yeah, I see it already, but I don't know why I share again.
Share the whole window. No, whole entire screen. Yes.
Okay.
Can you dial in from another terminal, not just your dial in for 6 different terminals, please. Okay, sorry about this. We have a bit of technical difficulty. This is the first time we're using translation. We may be too ambitious to try to show translation and the presentation at the same time. So will inflation be a concern for the Fed?
Well, at this point, of course, we are talking about higher rates, higher tariff rates, meaning things are more expensive. So the best scenario is for this what we call it one-time shift in prices, right? Prices higher and then stay. Instead of going higher and higher and higher, prices go one time up. Because tariff is a tax, right? Think of in Hong Kong, you're very lucky. You don't have a GST, you know, or sales tax or goods and services tax. In Singapore, we have a 9% GST.
Yes, Singapore has that.
Yeah, so in Hong Kong, you're very lucky. So you cannot imagine what it is like. So what happens is that prices will shift up. Prices will shift up, just like what happened last year when Singapore raised the GST. So prices shift up. So our inflation rate is about 2%, 2.7%, 2.4% last year. So this year, inflation is not going to be as high as last year because prices stabilize, right? Instead of going higher and higher. So tariff will likely, the best scenario is for the US, tariff rate will cause prices to shift up one time and then stay there. Inflation rate will pick up and then will kind of stabilize and then come down 12 months later, year on year, right? 12 months later. So right now we still have to see.
When do you expect this one-time effect of price hikes or the inflation?
All right. So
this year?
Tariff, well, this year should see the price hikes because I think businesses will pass on to consumers really quickly.
I see.
Right.
What happened this year? And do you think the Fed will cut rates before seeing that or inflation or after seeing that inflation?
So I think the Fed will probably consider two options. I mean, two parameters, right? One is a price action. And then the other one, more importantly, is the activities data. Now, if labor markets start to lose momentum, or manufacturing, production, services, whatever, start to lose momentum, even with the prices going higher, for example, inflation picking up, if it's not too much, if it's not too much, what I mean by too much, right? If it's not too crazy like what we had seen before, 8-9% or that kind of situation, I think the Fed will take priority over with the activities rather than price. So they will take action with that. Yeah.
So again, let's wrap this up into the US dollar discussion.
Right.
We talk about the US economy. We talk about the Fed. Any other factors that we should incorporate when we think about the US dollar and also the US dollar assets?
Okay, so the US dollar asset, let's quickly, okay, let's think about what happened after Trump announced the Liberation Day tariff, right? 46% for Vietnam, 30-something% for Thailand, 26%, 25% for Malaysia, all those crazy numbers. And of course, 145% for China at the time. So what happened was that the financial markets look at the situation and say that equity markets reacted negatively. A lot of attention on that, I'm sure, right? In your work and with your clients, you see big adjustment in prices, downward adjustment on that day itself and subsequent days. Now, what a lot of people don't see is that the Treasury yields have also picked up, right?
I see.
Right, Treasury yields. Now, you think about the US. Unfortunately, I don't have that page for you to see. You will see that the Treasury yields.
Yeah, no need to show. We all know the Treasury yields gone up. As almost 5% at one point.
Right. Yeah, exactly. Almost 5%. But what I also want to tell you at the same time, right? At the same time, I use an example: German bond, right? German bond yields, your 10-year, your 30-year German bond yields actually drop. Now, interesting, right? So because if you think about US Treasury is supposed to be a safe asset, safe haven asset. Yeah. When the yields pick up, means
uncertainty, right?
Yeah.
During times of uncertainty like the reciprocal tariffs, we all expected the Treasury yield to come down, but it did not.
Right. Exactly. So it's the opposite. Right. So it's the opposite that happened. So that means people are actually moving away from so-called safe assets, US dollar, US dollar, and also Treasury, right? Moving away. So what does that tell you? So the market is sending a signal, despite now, if you look at now, our equity, look at Dow Jones, S&P, basically back above the before the Liberation Day tariff, right?
Yeah.
Announcement already back above. So that's equity. However, the dollar and also Treasury have not gone back to before. If you look at the yield curve, has shifted all the way up. It is right now, it is probably the highest during Trump administration 2.0 administration is the highest level. So that means the financial markets, including the US dollar, is sending the signal that Trump is really messing up the US dollar function at this point, the US dollar status at this point.
The status of US dollar as a safe haven. So
That's
you
right.
mentioned something really interesting there. You say people are selling. So there's been a lot of speculation of which countries have been selling US Treasury. Some people say it's Japan, other people
Yeah,
say
some
it's
people.
China,
Yeah.
maybe even Europe. So
Yeah.
based on what you know, you talked to a lot of banks, for sure. Banks are big players in this space. What's your assessment of,
So
is everybody selling, or is this a particular part of the world that's really anti-US dollar now?
okay, so at this point, it is really hard to pinpoint, right? Is it the big banks, are they selling, or the country central banks are they selling, right? Some people will say
UOB.
that.
How about you? How about UOB?
We still hold US dollar treasuries, we say US
Yeah.
Treasury,
Is UOB selling US Treasury and buying
Well,
gold? By the way, you guys do have a gold business that's thriving, right?
Yeah, we have a gold
We can talk
business
about
and
it
all
in a
that.
second.
So it's very difficult to tell at this point, whether it's the central banks, of the world, are they selling US dollar, US Treasury, or what is going on, right? So one report put it that there are actually some speculative activities that have been going on even before the Liberation Day announcement,
Before,
right? Even before that, all these basis trade or whatever, it has been going on. So now the blame, if you look at, I think IMF has already released a global financial stability report, right? Basically, arguing that most likely the hedge funds, they are doing the selling because of all these speculative activities, and you have, let's say, for example, equity markets coming off, so there's a margin call on the equity markets, so they have to sell something to cover the margin calls on the equity side. So I don't.
Yes,
right.
It's all related. Well, even even Bitcoin was down at one point, and
Precisely.
we really don't know how much leverage there is in that market too, right? The cryptocurrency also, it's a $1 trillion, $2 trillion, $3 trillion market.
So I don't think at this point, I don't think the central banks are offloading big time on the treasury. Most likely it's the speculative activities on the other side, maybe some of the hedge funds, and leverage funds or whatnot, they are doing the selling but at the same time, of course, now a bit of question on, is Trump really Trump is really messing this thing up, and the status of the US dollar is in question, because if you think back what Trump has argued earlier, we want a weak dollar, and I want to encourage manufacturing to come back, I want to make import expensive, etc., etc. Those things. So Trump, let's say, is for a weak dollar. In that case, then other people will think about, investors will think about, why should I be holding US dollar assets at this point?
The expectation is for a weaker dollar. And how much of that concern, the selling, is because of concerns with the US credit quality? So as you know, Moody's recently downgraded US to one notch below AAA. That was the last of all the three rating agencies now. They have all downgraded the US to less than perfect. What's your thinking on that? And then we have this big, beautiful bill passed in the US. And like I said, Trump is doing a terrible job in terms of trade, which has angered many people. Now he's maybe also doing a terrible job with the fiscal situation. So can we talk about the fiscal situation in the US in relation to the dollar?
Sure. I think so people question, right? So you have a downgrade going on, but the thing is that the downgrade, like what you said, Qi, is the last of the three. So that means the other two have already downgraded before. So it's the last one. So it's no longer a new, it's not a new news, right? It's old news, actually.
Yeah.
And when it comes to debt, I have a chart here. You can take a look at the debt situation.
Let me see.
Right
here, this one?
18, page 18.
All
right, that's the one.
This one, okay.
Yep, that's the one, page 18. So this is the US debt situation. Right, it's going on, it is about 25 trillion US dollars. that are held by the public. Now, the question is this sustainable? How sustainable? Let's look at the next page. We have a better perspective in terms of GDP.
Yeah.
Right. In terms of GDP is better. 26 trillion, what does that mean? It's 121% of US GDP at this point. Now, if you think back, during Reagan times, all the way to Clinton, Bush, and all that, the average is roughly about 50% of GDP, right? So things change. Things change when? Global financial crisis. There's a pickup, all the rescue for the banks and whatever that we've done. And then another pickup happened during COVID time, right? So you can see the pickup is quite so accelerated.
That was during Biden, right?
Yeah, it was during Biden because of the COVID. So all the free money that's giving away, somebody has to pay for it. So so what happened was that a lot of the 5-year debt was issued during that time, right? 2020. Now 2025, a lot of this 5-year debt has to be rolled over.
Yeah.
A lot of 5-year debt. If you remember, 5-year debt.
Remember, yes. And that's been talk of the market. So mostly it's this year. So what do you think is going to happen?
Yeah. So the 5-year debt at the time was you remember the 5-year Treasury yield back in 2020 was around 0.2%, 0.3%. Right now is about close to 4%, right? The 5-year. Now, the question is this sustainable? You look at the chart, is this sustainable? The thing is that, in equity markets, I'm sure you have this saying, right? Things will stay sustainable until it's not.
Yeah.
Right? Prices will stay overvalued until it's not. Right? So it's the same situation here. The thing is that as long as the US dollar is still wanted, as long as the US dollar is still a reserve currency, this debt will be rolled over. The question is, at what price?
Yes.
At
In
what
fact, you're
cost?
right on. Yes.
Yeah.
The
At what
US,
cost to the US?
What cost? And then our research also suggests the US deficit situation is also largely dependent on the cost, the interest rate cost.
Yeah.
It accounts a lot of the deficit today because a significant part of the US government spending is actually or outflow is on interest expense.
Right. So just give you an example. US budget is about fiscal expense is about 7 trillion, right? Interest cost is about close to 900 billion, right? And defense and all that is going to be around 900 billion, 1 trillion US dollar.
Yeah.
So here we have this situation. Is it sustainable? If you look at the chart itself, and say that is higher than historical levels, is clearly not sustainable. But the thing is that as long as the trade, your financial markets, the financial system is still dominated by the US dollar, you have no choice, but you have to buy the treasury. Right? You have to buy the treasury to deploy your US dollar. There's no choice. And we don't want the dollar system to collapse because we are simply too intertwined. We are simply too intertwined at this point. Now, take a look at the next page 21. Yeah. Look at the table.
21 or 21, right?
21, yes.
Yes. De-dollarization, yes.
Right. Now, take a look at the whole world, 26 trillion. Of the 26 trillion of the amount, 9 trillion is being held by foreigners. Can you imagine if the system collapses? All this will become zero. These are held by central banks. These are official foreign holders. These are basically the central banks and whatnot. The biggest holder is Japan, 1.1 trillion US dollars. Can you imagine 1.1 trillion disappear one day? So no one can afford. UK is the next one, 780 billion US dollars of treasury held by UK. China mainland, 765 billion. So it is in everybody's interest here on this page to keep the dollar intact until something comes along.
I see. So even if they want to decouple from the dollar, it's not in the best interest now to decouple.
That's right. Exactly.
Because it's going to cause havoc, and it's going to cause.
It is a total seizure that we will not be able to recover for a long, long time, right? So if you flip one page above 20, there's China. The red line is China reserves, right?
Yes.
The blue line is the Treasury portion. It is a substantial portion of the China reserves. China
Yes.
cannot afford to have the system collapse on them.
Yeah.
So it's
That's
all,
my view too.
yeah.
It
So
doesn't serve anybody for China to
yeah, it was
fund the U.S. Treasuries.
Can you imagine all this go to zero?
Yeah.
Right? It's going to blow a big hole in the reserve. So
Yeah.
there's nobody interested. So the system, I think, is likely to continue to evolve for a while, to stay on for a while. And then for that, I would like to share on page 15, what do people think about de-dollarization, and what do serious investors think? All right.
Yeah.
So this is a survey done by CFA last year in July. About 4,000 members, and all these members, 69% of them, the whole 5 years of their charter or above. That means these are experienced either asset managers or investors or analysts or whatever.
Yeah. The
Right?
smart money per se.
Right. These are the smart money. So what do they think about the dollar? Right. So the question here, I put in the red box: will the dollar lose its reserve status over the next 5 to 15 years? So the answer is overall, yes, 63%. We will lose its status over the next 5 to 15 years. So the question did not ask whether it's next year or 2 years down the road. It's 5 to 15 years. So as an investor right now, I probably have the runway of at least 5 years.
Yeah.
Think about
So
this.
no immediate crisis on the dollar, even
Right.
though we are facing a lot of pressure and Trump is not helping definitely with this issue. No immediate crisis, but we are looking at a gradual de-dollarization of the world. Is that your view?
Right. That's right. A gradual, maybe 5 years or even 15 years, right?
Yeah.
So
But
it's
it's
not going to
time,
be an
investors
immediate.
need to prepare now. That's the whole
Exactly.
point.
Exactly. So we need to prepare. I won't advise a panic at this point. There's no need to panic because there will be some runway. So when it comes to your investment, your client's investment, probably you need to think about how should we diversify,
Yes.
right? How do we reduce our risk and yet still have to make some money along the way, right? You don't want to be panic and then you shove everything to gold. And if gold prices don't go up, I mean, you're stuck because there's no return in gold, right?
Yeah.
Except
No
for the
return,
price.
no cash flow. And gold tend to have this very long drawdown cycles. That's one thing we always warn investors about, even though we also gold.
Yeah.
You could have a 9-year drawdown in the gold. You just stuck for 9 years. And, you could very well go at the bottom before it takes off again.
Yeah. So you may want to have a bit of it, but not too much of it.
Yeah, right? Control it.
Yeah.
So let's talk about what should investors do then, assuming we're right, that this is the time to look at, take a closer look at the dollar's role, the dollar's status, the de-dollarization. So we're not telling people to sell all US dollars, right?
No.
We're just telling people that you need to diversify. And then that's a real good advice because, and for context, I came from Wall Street. I have 27 years experience, and mostly my world is all US dollars. This is also the first time I talked to someone about seriously investing in a non-US dollar assets. Even for me, it takes time for me to learn and adjust. So just imagine how challenging. I'm sure your institutional clients also face the same issues. This is not an easy transition to manage.
Right. No, not easy. The reason why dollar is still dominant is because the variety of assets that you can deploy your US dollar, right? Be it treasury, equities, or whatever, private credit and all that. It's all dominated in dollar.
Yeah.
So how should we think about it?
Pegged to the dollar too.
Yeah, exactly.
Like Hong Kong
So how
dollar.
should we? So how should we think about this, right? How do we diversify? Maybe geographically, you want to be somewhere else, maybe a bit removed from the dollar. For example, Southeast Asia, maybe another place. Companies that may be of interest, they can still generate some returns for you in local currency. right? So maybe you want to think about those as well
Yeah.
to
So
diversify
this is
away.
something you have the most authority to talk about. What about Singapore dollar?
Well, Singapore
Is that
dollar
a
is
safe asset?
well, Singapore dollar is
Mhm.
good, and we have been enjoying quite a lot of liquidity. Our overnight interest rates has dropped to about 2% ish from 4% just last year, and this year just dropped rapidly without the Fed doing anything. The interest rate has dropped since the beginning of this year. But
Yeah.
anyway, Singapore is too small, right? So there are
Mm.
investors that deploy in Sing dollar. Unfortunately, our equity markets, the performance not as good as Hong Kong equity
Mm.
market, not as deep, not as liquid,
Mm. Yeah.
right? Yeah.
And the bond, there aren't that many bonds to choose
Well,
from. Yeah.
exactly. It's not
Very
that many
few
bonds,
choices. So
right?
when we say Southeast Asia, what other countries are interesting to you?
So Southeast Asia, there's quite a bit of choices, and recently, quite a bit of money has gone into the bond markets in Southeast Asia, Malaysia bonds and Thai
Malaysia,
bonds,
okay.
local bonds,
Very
and
good.
even Indonesian bonds, right? Because the
Indonesia,
central
okay.
banks, all the central banks are expected to cut interest rates quite a bit. So in terms of price action, it is more supportive. Of course, the market again is not as deep, right? And broad for a lot of investors. So a bit of money in this region, maybe you think about it, some of the equity names may be of interest to some of your clients as well. I'm sure you are in a much better position, with Hian has a lot of exposures and analysts in around Southeast Asia. Right,
Yeah.
so there will be
Our
some
advantage.
interesting names for companies for investors to look at. They are in a better position to
Okay.
to
Two
talk
currency
about
I want
those.
to ask you about else, well, in Asia. Let me start the easy one, the Japanese yen and also
Mhm.
the RMB. So some people believe Japanese yen is a safe haven asset. It's very controversial, by the way.
Yeah,
The
that's
Japanese
right.
yen is massive depreciation pressure. What do you think of the
Mhm.
JPY?
Well, JPY, we think that okay. So if people think about, we go back about sustainability. Debt sustainability. US 121% GDP in terms of its debt. How about Japan? Japan's own debt is even higher.
Yeah.
So if you're worried about US, I think you should worry more about Japan too,
Okay.
relatively speaking, right? But of
Yeah.
course, these things because of creditor nations and things like that. So that's the other offsetting factor, right? So Japanese yen, because of I think BOJ is has to raise interest rates. Of course, now maybe it's a bit postponed and stuff like that. So Japanese yen probably will be interesting to look at as well.
Mm.
Right? Whether it has a lot more appreciation room, maybe not. Right? Maybe not. Yeah. On the other hand,
How about
renminbi.
stability? Just buy for stability, safe haven.
Yeah, yeah. Probably some people will do that, right?
Okay.
To get for some exposure. Of course, the other one is
RMB.
RMB, right? You talk
Yeah.
about RMB. Is that going to be a
Yeah.
replacement for the US dollar?
Yeah. Oh, that's
Is it
another big topic. We can spend an hour on this, but what's your thinking
right?
on this?
Okay, let's talk about what do the smart money think. If you flip down page 17, just I think one or two pages down, let's see what the smart money think about replacement. Another page, there's a round
Oh, this is
thing.
a great slide. Yep.
Yeah, right. This slide.
Yeah.
So okay, so assuming that US loses its reserve status, who is going to be the replacement?
Mm.
RMB. What's the share of those people who respond? 6% think that or thought that it's going to be RMB. 6% only,
Mm.
right? Is going to be replaced. Now, what is the biggest share of people responding? A multipolar currency
Multipolar.
system. A
Mm.
multipolar, right? So that means a multi-currency, multipolar kind of thing. That means the dollar is still there. Maybe other currencies will play some role as well, including the CNY. So CNY or renminbi is not going to be totally replacing the dollar in this survey, right? It's not going to be a one
Yeah.
for one. It's not dollar taking over sterling pound in the past. It's Chinese currency taking over from the dollar. So maybe we are talking about pockets, maybe in Southeast Asia, a lot more RMB being used compared to the dollar, maybe.
Yeah,
Southeast
those are the
in Middle
multipolar.
East.
That's the
you know,
multipolar theme you talk about. Southeast Asia
exact.
should be one of them, right?
Yeah, so dollar, current Chinese currency may be better circulated in Southeast Asia because of the closeness, because of the trade linkages, investment linkages.
Yeah.
But outside, the dollar may still be dominant in, let's say, Africa, because there's no other, or Latin America, because there's no alternative than the US dollar, right? There's no strong contender, so to speak, with the US dollar. So we are going to see this sort of a bit more interesting space. That means
I was just thinking that, the globalization or the internationalization of RMB, whatever Trump is doing now, the Chinese might be just quietly celebrating, right? Be trying so hard to make a RMB a global currency. RMB right now is not even a regional currency.
Yeah.
Right? Japanese yen probably is more regional currency than RMB.
Yeah.
But whatever the Trump is doing now is probably leaving a lot of room.
That's right.
For RMB or CNY to grow.
Yeah.
Take the place. Yeah.
Right. So take a look at page 23.
Yeah.
There's a lot of bars down there. Yeah. So this is a SWIFT system. I'm not too sure whether people are familiar with it.
People know this. Yeah. Russia got sanctioned on this.
Yeah, got kicked out of the SWIFT system, right?
Yeah.
So these are the settlements, for payments and all those things. So take a look at the US. The US dollar is still about 50%. In the SWIFT system, 50% is done in US dollar. Euro is about 22. Take a look at CNY. This is about 3.5%.
Yes.
Very tiny amount. Very tiny amount. Japanese yen is about 4%. If you think about Japanese yen being quite widely used, it's only about 4% in international transactions. So dollar has its place. So people say that the China has set up these CIPS, cross-border interbank payment system. So I can show you some statistics on the right hand side. Look at the SWIFT. How much do they handle? 150 trillion US dollar in the latest, I think 150 trillion, right? Look at the Chinese one at the bottom.
Billion. That's right. Yeah, I always thought it's a billion. It's a trillion, actually.
It's trillion, right?
Yeah.
You look at China, that SIP system is about 24 trillion. 24 versus 150 trillion.
Yeah.
So there is still a long way. It does not mean that it's useless. It will still have a long way to go, right? So we should not discount that the impact of CNY, but it is a long way to challenge an established player, particularly in the financial system.
Yeah, and this slide also implies that with the rise in RMB will also come with the rise of Chinese payment system. Am I right?
Yep.
Is that what you try? And I think that's also in China's best interest, because China saw what happened to Russia during the Russia-Ukraine war with the SWIFT ban.
Right.
I think that's China's worst nightmare if it happens to China.
Right.
If they want to do anything with Taiwan and suddenly, the Western world pull a similar trick on China as they did to Russia. So it's all in the best interest of China to do that. I know we have a lot more to talk about, but I want to leave plenty of time for Q&A for people on call. But before we wrap up the main session, and you tell me whether you can talk about this or not, because it's very controversial. It may be compliance issues. How does crypto, Bitcoin fit into this? We talk about alternative assets, right? Alternative currencies than US, Japanese yen, Singapore dollar, gold, and RMB, or CNY, CNY or RMB, the same thing, then Bitcoin.
I don't really dwell into Bitcoins and stuff like that because I think some people like it. Personally, I don't really pay too much attention.
Okay, no problem.
So I don't really pay too much attention to that. But the thing is that if you look at a survey, just now the survey of what would replace the dollar in a multi-currency or multipolar, the other option that people look at is digital currency. So that is an interesting option that people picked, right? It could be something else. And But unfortunately, I'm not that familiar with it, so I won't say too much. Maybe Chi, you want to tell the audience what you think about it?
Well, we save that later for the Q&A. I'm sure someone's going to ask this. But let me ask you a different way. The smart money, big institutions, banks you speak to, the institutional or banking, financial institutional clients, did that ever come up? Do people ask you about crypto?
In the past, yes, when it was very hot, and it's died down since then. And okay, for the bank, right? For the bank itself, for the bank, I think other local banks in Singapore, for the bank itself, we don't really look at cryptos and stuff like that, but rather we look at the mechanism behind, which is a blockchain.
I see.
Yeah, so we look at
blockchain is more interesting than
technology, not so much of the crypto as an asset or investment.
Well, that's Ethereum, right? Ethereum is both. It's a technology chain as well as a cryptocurrency. Great. Yeah, very clear, very clear. And before we go into Q&A, I just want to say that UOB Hian, we do offer a broad range of products for both US and non-US dollar. And for professional investors, if you're interested in exploring further this theme about diversification from US dollar assets, please contact us. We have two people here, Gaho Lam in Hong Kong and Ryan E in Singapore. And with that, let me turn to Q&A. For audience Q&A, anyone has a question, please use the chat window, the Q&A window or the chat window, either one, to ask the question, and we will answer them in the way, in the order they come in. Man, can you help me pull the Q&A window? So we can get rid of it.
Oh, there's someone raising hand, I think.
Okay, someone raised hand. I didn't see that.
Yeah, I see that on my end.
Okay. Or if you can, Teck Kin, if you can see the question, feel free to read it out. We just try to open up the correct window. There's like a gazillion windows here.
Yeah, I know. I'm having issue also on this side. I don't know which one I should be looking at. Actually, I cannot see. I'm not able to see the chat box.
No worries. I'll read the question to you.
Yeah.
Again, if you have any questions, please use do they use the Q&A function or the chat function?
Q&A.
Q&A function. Let's check the chat too. There's nothing here, right?
Okay. Q&A.
Well, while we queue up for the questions, for this topic, Teck Kin, can you highlight to us what are some of the key events we should be watching for the remainder of this year if we were to closely monitor this US dollar trend?
All right. Of course, I think the tariff is still at the top of the list. So we have a deadline that is rolling in July, right? 8th of July. That will be another one. Of course, this morning, you heard about the US Court of International Trade, right? ITC, International Trade something. So putting down the ruling that these tariffs, put a stop to the tariffs, put a stay on the tariffs. Of course, the Trump administration is appealing for that. So we want to see the development because if you look at the dollar reaction today, right, especially at the beginning of the early morning, the dollar actually strengthened on the news.
Yes.
Right? The dollar actually strengthened on the news. That means the dollar weakening has to do with the bad news also on that on the tariff fund. So good news on the tariff, dollar strengthened. So we can from this kind of simple extrapolation, that means tariff has a lot of swing factor on the US dollar. Right? So we want to watch what Trump is going to say, what sort of things will be coming up. The other one, watch for in June, very soon, in about a couple of weeks' time, the Fed will be having its June interest rate meeting.
Yeah.
You want to hear what the Fed speakers or the chairman Powell will be talking about, because he has been resisting Trump's pressure to cut interest rates.
Is that the first rate cut expected in June?
No, I don't think so at this point. I think the market has pared back as well. The futures market has pared back. Most likely will be towards the second half, towards the third quarter or fourth quarter, maybe September, October, that sort of time frame.
And then what about this refinancing situation of the US debt we talk about?
Okay, refinancing, I don't see. Okay, just give you some scary numbers. 2025, about 8 trillion US dollars to be refinanced in terms of debt, the whole year, 8 trillion.
Yeah.
About 5 trillion will be over the next May, June, July, August, 4 months, roughly. Now, the question is the US going to be able to refinance? I think there's no question. After hearing our talk, there's no question. The US is able to refinance it. The question is at what interest rate and what cost.
Yeah.
That's all.
What do you think? Is it going to be higher than expected?
At this point, interest rate, the bond yields, there's no sign of the bond yields coming down big time, because all these tariff issues, the way that the big beautiful bill is going through, there's no meaningful ways for the bond yields to come down at this point, right? There's no excuses for the bond yields to come down. Okay, so
when people realize that, do you think that will be another potential risk to the market? I'm not sure the market today really pricing much of this higher funding cost for the U.S. government. It may have, but my gut feel it has not, especially the equity market. By the way, the equity market is like fully back to April 2nd levels, or even higher.
So, if you have a higher bond yields, for example, unless we are talking about into 6%, 7, 8, 9, 10%, if it's at about 5% below, I don't think it's going to cause too much distress to the U.S. fiscal situation, because you're talking about already paying 900 billion or so in terms of interest expense. If it goes into 1 trillion, for example, in terms of interest expense, is it going to be a killer? Well, they have to come up with money from somewhere else, right? Some of the programs were to be cut here and there, even defense spending. This is a discretionary spending that they should be looking at trimming, not adding to it. Right. So, it's up to the government's choice at this point. That's the reason why the big, beautiful bill, barely scraped by in Congress.
I don't think Trump is going to cut spending. Based on his rhetoric. So that's my next question to you. Yeah. When we talk about the U.S. debt situation, whether it's debt to GDP or deficit to GDP, the GDP is one factor here too. So what Trump is telling the market is that regardless of how the spending and the budget's going to go, he's going to prop up the economy, right? He's going to grow the economy through deregulation, through all kinds of stimulus.
Deregulation, stimulus, whatnot. Yeah,
what do you think about it? Is he able to do that?
Well, he's going to, for example, he's a big deregulation person, right? So he's going to come in with all sort of deregulation, drilling in Alaska or whatnot, right, to bring down the energy costs, and also other sectors, maybe even financial sector, maybe in terms of capital usage, things like that. So probably very equity market friendly kind of things might come in along the way, right? So, but the thing is that, the market will assess and say that, okay, you can do all these things, but at the end of the day, it will be still government expenditure, right? It will be still higher payment of this and that, whether the market is going to buy that or not. If not, for example, if you look at the Liberation Day tariff, why did he pull back so quickly? Because the bond market is sending you a signal. Yes. If you continue to do this, you're going to be punished, right? So he quickly pulled back 1 week later.
That's also our U.S. strategist Paul Davino's view. Almost every U.S. president care about bond yields. And that's the ultimate button to push if you want. But so what you're saying that whatever Trump is doing is probably not going to change the economic outlook that much, but it's really about how the market perceive it. But I'm just thinking out loud. I don't think deregulation is going to change the U.S. GDP growth in 1 to 2 quarters, right? This is really more of a medium to long-term thing.
Depends. Some deregulation can have very quick effect.
Like
so it
what?
depends on what
Yeah.
depends on what he's going to do, right?
Okay.
Maybe relaxation, a lot of things like in terms of regulation on, let's say, banking sector. If we're loosening on all sort of other things that could quickly pump money into the system, because the banks are able to do a lot more with the capital that they have, with the deposit that they have, right? So
Yes.
depending on what sort of things that he's going to do. But other than that, you are right, Chi. Some of these regulation may take a long time for it to turn into reality.
Yes.
Even with the tariff, right? So that would depend also on what kind of deregulation, maybe in the drilling, energy, and all sort of other areas that could quickly see investments being poured in quickly, right? So it depends.
You talked about the trade negotiations earlier. The tariff definitely is going to be a big driving force for the U.S. dollar, the trade policy, the situation. So,
Yeah.
any predictions on the potential outcomes of? We are tracking maybe 2 or 3 trade negotiations right now, right? China's a big one.
Yeah.
Am I right? Japan's a big one, and Europe. Any predictions on what's going to happen there?
Well,
Those 3 big areas of negotiations. Yeah.
Well, we had quite a bit of discussion within the team. What kind of outcome are we going to see with all these 90-day expiring? So right now it is we are still scratching our heads. What is likely to be? So there will be one scenario. A very good scenario will be the tariffs will be gone totally. That will be the best scenario that we're going to get. Of course, I think the probability is very low. The other one is the
very
10%.
low, because again,
very
if you
low.
look at the big beautiful bill, U.S. is counting on tariffs to be part of the income. Am I right?
Yes, that's right. So they expecting to generate the kind of revenue, which I think is again not that easy. I don't think that is feasible even for the US to count on a tariff to be a main driver for revenue. It hasn't been the case for many countries for many years, and I don't think US is going to do that. So unless you are talking about crazy levels of tariff, in which case, not much activities will happen and not much import will happen, and that will also defeat the purpose, right? So the tariff will likely to stay in our discussion, most likely will stay at maybe 10% for many as a base, and then you get up down for certain countries.
Yes.
Right, for certain countries. So it depends on I think the 46% for Vietnam, the Liberation Day or the reciprocal tariffs unlikely to come back. Because the markets have already sent the signal. If you were to do this again, that will be another round of bloodbath.
Just to set the context, that this 10% is much lower than whatever you just said, right? April 2nd levels.
Yep.
But 10%, I believe, is still the highest since 1930s.
Yep. Precisely. Yeah.
Okay.
So, yep.
Let's try to answer some questions for the audience. Sorry, we have a lot of technical difficulties today. We just saw these questions coming in. First question, Teck Kin, is the market underpricing the risks of prone or failed auction of the Treasury? Will there be a failed auction of Treasury? I think you just answered that question. There won't be any failed auction. It's just about the cost, right?
Right. I don't think there's going to be any failed auction. That would be a scary day if that's happen. That would be a scary day, because that means there's no buyers, right? So I'm putting out this for auction. I'm going to roll over my debt. For example, I roll over my 5 years, and there's no taker at all, right? And I mean, it is a crazy scenario. So it could happen. Never say never, right? It could happen, but I would assign very low probability. But what would happen is that the bid to cover ratio probably could be low. That means not very keen. But then the thing is that if you think about it, all these buyers out there, who are the main buyers? Domestic buyers are still the big ones. You have the funds, you have the banks, you have the whatever, all those things. They would have to renew, right? They would have to earn interest. So if the yield is high enough, they will take it up. Again, it's a matter of cost.
Yeah.
Yeah.
Next question. What is the outlook for the US 10-year Treasury? And then is TLT, by the way, TLT is not 10-year, TLT is 30-year. Is TLT a good buying level right now?
Well, I wouldn't be able to comment on whether it's a good buying level,
Okay.
but what yeah, but what I would imagine is that the 5-year yield, the 5-year yield or 10-year, 30 or whatever, if you do you expect that you continue to go higher and higher in this scenario? I mean, there's this scenario that you continue to go higher, but at some point the buyers will have to come in, right? Because the yield is attractive enough to pick it up and lock it up, right? To lock up the yield. So I don't imagine a situation where the yield continue to go up higher and higher, right? So is it attractive enough?
It's very
Well,
speculative. TLT is
yeah, I
very
mean,
speculative. It's
yeah,
so
why
long
not?
duration.
Yeah, that's right.
I would recommend against it.
Right.
Well, if you want to take an interest rate view, if you want to take a Fed interest rate view, 2-year would be the best, right?
Yeah. So if you're expecting rate cuts,
Yeah, rate cuts. And then if you want to take a US credit view longer term, I would think 10 years is probably the most I will go.
yeah.
Otherwise, it's and over long term, we are seeing very how do I say, very fundamental changes in the US dollar over the 30-year time frame. So next question is, are there any potential risks that EU is going to sell US debt to finance their growth and defense? I think we also touched upon this topic. No one's really going to dump the US Treasury
Yes, that's right.
unless under very extreme situations. But
Exactly.
this question focuses on whether there's any practical need for Europe to sell some treasuries.
So at this point, if you are talking about just minor adjustment here and there, probably because of allocation, you make this kind of decision. But if you are talking about wholesale kind of moving away, selling, it is quite low probability at this point, right? There's in nobody's, like I said, it's in nobody's interest to have the system collapse on you, have the prices collapse on you, right? It is nobody's interest at all at this point. So they will make sure that the system can work and continue to work for everybody's benefit, actually.
Got it. And another question focuses on your prediction for the Malaysian ringgit.
Malaysian
did talk
ringgit.
about Malaysia, Southeast Asia is interesting, right?
Yeah, Southeast Asia interesting. So if you look at what happened recently is there's a lot more flows into the bond markets in Southeast Asia. So the question is one Sing dollar to $1 to 5 or whatever, one Sing dollar to 5. I don't think that is happening at this point. I don't think that is not in our forecast as well. We see that the ringgit actually could strengthen, for example, against the Sing dollar, could strengthen somewhat against the Sing dollar. Now, one Singapore dollar, let's say last year at the peak, 3.5 US dollar, 3.5 ringgit. Today is about 329, 328. So the ringgit has actually strengthened a bit. Now, why is that the case? Because MAS has kind of what we call that instead of strengthening the Sing dollar, it's not it is doing the other way. It's kind of flattening the Sing dollar or steepening, right? It's less steep in terms of appreciation policy, right? Less steep. So the Sing dollar is not strengthening as much as what it had used to. So the rest of other currency are actually catching up. Now, are we talking about weak Sing dollar? No, we are not talking about weak Sing dollar. So Sing dollar strength is still there, right? Sing dollar strength is still there. It may not be as strong as before. Another quick example for you. At the peak, Sing dollar was about 120 yen to 1 Sing. From 90 yen to 120 now is about 110. Sing dollar is still strong, right? So not as strong as before, relatively speaking, that's all.
Oh, Sing dollar tend to have these very long cycles of strength.
That's right. Yeah.
I would say probably going forward, even more demand for that because it's a very unique currency that has special safe haven status. Even though
safe haven, you have a very well managed fiscal position, huge amount of reserves, and nobody knows how big the reserves are, except the government, right? So very strong backing. Yes.
Got it. Okay, no more questions, and we're right on. We slightly past the hour. Thanks again, Teck Kin, for a great presentation and some
Thank you so much.
very useful insight to help us understand the US dollar trend and de-dollarization, and how investors should be preparing, what we should be monitoring. We talk about the alternative assets and alternative strategies. The replay of this call will be put up on our Wealth Vision, UOBK Hian Wealth Vision YouTube channel. So feel free to listen to this again. Again, thanks everyone for participating, and thank you again, Teck Kin.
Thank you. Thank you, Really
Good
appreciate
night.
it. Thank you. Good night. See you, everyone. See you.